All right. So, guys, good morning, and you are welcome to the continuing lecture on investment appraisal. All right. So, we want to do the impact of taxation and capital allowance. But before then, I gave an assignment that everybody should try and see if you can get the answer correct. So, some of you on YouTube sent me your answers, and my class too also sent their answers. And I realized that there's a need for me to solve the questions for you so that you know how you got yours wrong. Everybody had it wrong, which is dangerous anyway. So now, um, when you are doing any investment appraisal question, we learned it from the basic investment appraisal. Maybe you skipped that video, you have to go back there. So when you are doing an investment appraisal or anything capital budgeting, there are certain things you must remember. One is that we use relevant cash flows, all right? And we explain what relevant cash flows are. Incremental, futuristic cost, all right, that you incur. So an opportunity cost. So you need relevant cash flow, which means that if you read the question and the cash flows are not relevant, you have to ignore that. Take note of that. Number two is that whenever you are doing investment appraisal, you must understand that the outflow is now. The outflow is now. The outflow, I mean, is the capital expenditures. That one is now. Because you are going to spend money today and you want to see how that money will be generating returns for you. So the outflow is now. Then the inflows are in future. And so you realize that your inflow starts from year 1, year 2, year 3, year 4. All right. And please let me clarify this, because if I don't, some people will misunderstand it. When I say the outflow is now, my reference is to the capital expenditure. It doesn't mean that if year 1 there is an expenditure, I'm saying the outflow is now, so you have to bring it to year 0. No. I'm saying that the capex, all right, the capital expenditure is now. All right. Now, so that is what you need to understand. Then, most importantly, understand that the cash flows that we are using to do the investment appraisal, whether the outflow or the inflow, it is assumed that they all happen at the end of the year. So they all happen at year end, not at the beginning of the year. They all happen at what? Year end. Listen, so this is how it works. This is how it works. So if today is my year 0 and I have this year 1, this is at year end, the end of now. So let's say if I'm doing an investment appraisal, let's say this one is my 31st December. We are not in 2024, but I'm going to use 2024 as my now, all right? Imagine if this year 1, year 2, year 3, year 4, and probably year 5. If you guess what? If the cash flow that is happening here, let's say if it is 1,000, if this cash flow is happening at the beginning of this year 1, it will be 1st January 2025. Have you seen that? But you do realize that it can't be, because we are going to be PVing these figures to 0. That is why when you are doing the PV, we say 1 plus R raised to the power N. N means 1 year apart. But imagine if I'm doing a PV for this figure, can I do a 1 year apart if this is at the beginning of this year? No, I can't do it. So you must understand that the figures that you are PVing to year 0 are also at the end of the previous respective accounting years. You must understand that. It's very, very important. You must understand that. So that if this 10,000 is also at 31st December 2025, I can now PV it 1 year by doing 1,000 multiplied by 1 plus, if let's say the rate is 10%, so I can get 1.1, right? I can get it as 1 plus R here in, let's say 1 0.1 raised to the power 1. Then I'll multiply it by my 1,000. So you could see that it is 1 year apart. So ladies and gentlemen, if you are solving a question, and the question, so it is assumed that all the cash flows are at the year end. The question doesn't need to tell you, but you should know that all the cash flows are at year end. All right. So if the question now tells you that the cash flow, one of these ones, is at the beginning of the years, that means that, and one thing you must understand, you are accountant, that balance carried down is equal to what? Balance brought down. So if I tell you that this 10,000, this 1,000 is at the beginning of year one, then it means that actually that 10,000 is here, or that 1,000 is here. So if it is for 5 years, therefore, it will be 1, 2, 3, 4, and 5. That's how it is. All right. So that is that. So even though you realize that some of the flows are supposed to be happening at the end of each year, if the question tells you that they are at the start, then it means they are actually at the end of the previous year. And something that we are going to learn today because of taxation, as we are coming to bring in taxation and capital allowance into the equation. So now let's go back and solve our question. I think with this explanation, you understand it better. All right. So we saw the question, and so you have your template. You should have your year one. It was for 5 years, year 2, year 3, year 4, and your year 5. And we do these things as if we are doing our P&L, like I told you. So let's just drop some 3 zeros there. All right. So see this in 3 zeros. So we start with our revenue. And per the question, they said that the person is investing 7 million, which is your capex. All right. The net contribution over the years and is 4.2 in real terms. And I've shown you that if the inflation rates are plenty, we have to use what? Money terms. So if it is 4.2 in real terms, then it means the figure is actually here. However, you have been told that the inflows are supposed to happen what? From the future years. So if this is our now, the inflows must start from here. You cannot start the investment today and end today. Like, it doesn't happen. Think about it. Sometimes not all things are booked. You have to really think about it. All right. So that is that. You are doing the investment today. At the end of the year zero, to start earning so at the end of each year, what you've earned, you PV it to today. All right. So that is that. Now, if it is 4.2 and we are told that the contribution is growing by 8%, so this one is growing by 8% annually, then what I will do is I have my 4,200 multiplied by 1.08. All right, so what I have is 4,536. I think most of you got it correct. So I keep doing that every year. So I'll be rounding the figures because this place is rounded. I'll be rounding the figures. All right. So here too, I have something like 4,899. All right. So if you had that, that was good. Then I'll be rounding it. All right. So this one gives me 5,291. Then again, I go again. So 5,714. All right. Then the last one, I go again. So that gives me 6,171. All right, so that is that. Well, how am I getting this figure? I take the 4.2 every year. So 4.2, and I'm multiplying it by 1 plus r raised to the power n. So each year, the r is 0.8, 0.08. Then each year I put here. So if I go to year 2, this is how I do it. So basically, that is that. All right, because sometimes the way we punch it on the calculator, the figures that may be given to you in each year might be different. You have to do the inflation well. All right, so that is that. And we are told that there is a marketing expenditure, there is another expenditure. So you see the marketing expenditure, we are not told whether it is at the beginning or at the end, but must know that it's assumed end, because that's the assumptions of investment appraiser. But when you are told it's at the beginning of the year, then be careful. So that is that. So we have less our expenses. So we have marketing. and the marketing expense is 1.4. So 1.4, let's say 1,400, and the marketing expense is going to grow by 3%. So 1.03. So it was 1,004 divided by 1.03. So here I have 1,442. Go again. 1,485. 1,530. Once again, I'm rounding the figures, so it doesn't mean your figures might necessarily be wrong. Here is 1,576, 1.03, 1,623. So that is what I will have. 23. Good. That is it. Then we have another expenditure. This expenditure is telling us that it is 1.3 will be required to replace the existing assets, which will now be used in the project, but are getting to the end of its useful life. Good. This expenditure will be incurred at the start of each year. Here we go. So we have expenditure on assets, so replacement, kind of. So I told you that when you are doing these ones, especially we discussed replacement the last time. Replacement, per your understanding, should be able to tell you that it is not a repair. You understand? It's like a capital expenditure. In fact, that one should have even helped you. Replacement is not a repair. So replacement is mostly seen as a capital expenditure. All right. So, but the question even helped you to tell you that the expenditure will be incurred at the start of each year. Now, like I told you in this, if it is at the start of each year, then technically it is the end of the previous year. So that is that. That statement, you have to be very, very careful about it because it's a critical assumption of investment appraisal we need to know. And when we are doing the taxation and the capital allowance, I will explain it to you. It's dangerous. All right. So that tells you that this 1.3 actually starts here. That is it. We won't inflate it here because this is the end of the year zero. Then 1,003 is supposed to be inflated by 4%. So I have here 4%, sorry. I have here, so that is it. I have here 1,352. I go again. 1,406. I have here 1,462. Then the last one, because it's for 5 years, so 5. The last one will end at year 4. I go again. 1,521. That's how it ends. All right. So that is it. So for most of you, when I looked at your answers, you actually started here, 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 and you did it here. And so that was the only error that made your work wrong. So working capital was also there. All right. So these are for working capitals and others. So we come in with our capex. Our capex is 7 million. Of course, you can decide to total this side before you continue, but you'll be wasting time. That's how I see it. Then we have our working capital. So let's work our working capital. We are told that the working capital will be needed. So 10% of contribution will be needed. Now, what is the contribution? Now we have done the contribution. We know the contribution for each year. We have it here. So per what we have, so that I can have it here. So year 1 contribution is 4. The contribution at year 0, you remember, was 4.2. You remember at year 0, but we don't really look at that, and so we actually look at those ones that are in the years. But you should remember that it was 4. But so here in real terms, so we don't need this for now. So we should start our year one to be 364,899, 5291, 5714, 6171. So that is what we have. And they said that it is 10%. So 10% for this should be 454. All right. And this one will be 4 rounded. So that would be 490, right? We round this 429, 571, 617. All right. And you see this also that they said that the working capital will be released at the end of the project. We all know that. We all know that. And it says that, so this is what I'm looking at. The additional working capital is 10% will need to be in place at the start of each year. So the working capital is always like that. And that is why when we finish, we are always doing the movement. We are always doing the movement. So you saw that at year zero, it was something like that. You saw. So when you are doing the shifting, this minus this for your year one is here. You could see clearly is here, is here, is here. So if you could see clearly that it's not that the working capital, so at year zero, so you are now coming to bring the thing and move it. So this is basically how it is. So it's also at the start of each year. So that's how we do. So as you know, we were supposed to use these ones to inflate. So we use these ones to actually get these figures. But in terms of our working capital, we were not told that there was any working capital. So you realize that this movement also, this movement also comes here. So you will not be doing this minus this. This was what was given to you to be able to derive the other figures in real term. It wasn't a working capital. So that is that. So technically, it tells you that the working capital is zero. And working capital is something we've been doing. So here, you know that the movement will be 5. Yeah, that is that. So what will it be? 454 minus 490. That is 36. I think this one, everybody had it. 490 minus 529, 39. I think this should be 42, right? 529 minus 571. Yes, because the interval is becoming 3, 3, 3. And usually that is how it is. So this one will be something like 45. So 571 minus 617. Hey, 46. All right. So that is that. So we add everything. 454 plus 36 plus 39 plus 42 plus 46. This is because of the approximation, I guess so. All right, because everything must sum up to usually this figure. Is that what I'm having? Oh, my first figure is wrong. I did 545. It's supposed to be 454. Yes, I have it now. 617. So this is it. I pick these things, go and drop it in my investment appraiser. Okay. So all these ones, I pick them and I go and drop them. So let's see. Yeah, can copy them from here. So here is 454. Come up small. 36, 39, 42, and 46. Then the last one, 617. Remember, we said the assumption under working capital, even if the question does not say it will be released at the end of the project, you must know that it will always be released at the project. That's the assumption of the working capital. All right, so I think that's it. We are good. There is no residual value. All right, and we discuss all those things to the residual value and all those things. All right, so we have used the contribution marketing, and you see that this one is left, and the real cost of capital is given. So let's find we'll use the formula to do. So this is the net cash flows, all right, from everything. And so let's see how it goes. 1,003 plus 7,000 plus 454. That's 8,754. Then we have 4,536 minus 1442 minus 1352 minus 36 1706. All right, so basically that is that. All right. Okay, so now let's move on. This one is 4899 minus 1485 minus 1406 minus 39. That gives me 1969 5291 minus 1530 minus 1462 minus 42. That gives me 2257 5714 minus 1576 minus 1521 minus 46. That is 2571. Yeah, 6171 minus 1623 plus 617. That is 5165. So this is what we have. Then we need our discount factor. We need to work it. So the discount factor, it was given in real, but if we want the money, this is the formula we said the last time, into brackets 1 plus r, 1 plus I. And I said that you can just go straight forward and do m is equal to 1 plus r multiplied by 1i or minus 1. So if that is the case, our general inflation is real rate. Our rate is 0.6, so 0.06. That will be multiplying 1.047 general price or minus 1. So 1.06 multiplying 1.047, that gives me 1.10 something or minus 1. So the answer that I get here is 0.10982. So technically this is like 11% when you round it. So let's put here 11%. And of course, yeah, 0 is this. Let's go and use our table to bring it in. So per our table of discount factor, where is 11%? 11% is here. Let's check confirm. Yes, that's the discount. 11% is here. So year 1 of 11%, 0.91901. Year 2, 0.812. Year 3, 0.3731. 0.659. Then year 5 is 0.593. So we just do our multiplication. Don't forget this one is a negative figure. Let's do our multiplication. So this one will be maintained. 1706 multiplied by 0.901. That gives me 1537. 1969 by 0.812. That is 1599. Okay, so 2257 multiplied by 0.731. That gives me 164. No, rounded will be 1650. All right, then 2571 by 0.659. Rounded is 1694. Then 5165 by 593, sorry. That is 3063. All right. So if I now do the combination, let me take this one out here so that I can get my space. So if I now do the summation, these are the PVs anyway. So if I now do the net PV, which is the combination of everything here. So I have 3063 plus 1694 plus 1650 plus 1599 plus 1537. I get 9543 all minus 8754, right? And that gives me 789. So because of the approximations, so basically, and what was the answer I gave you before? I think it will be 790,000. So I'm sure. So just the roundings will bring you in. All right. So if you take up, I'm sure even with this one, a figure has been rounded in some way. Other than that, we should be getting the one exactly so that it will mount the 790,000. So basically, that is that. I've forgotten the, okay, so let me use this. It will bring it up. Exactly. So that is what you get. So you do yours, you can maintain the figures, you realize that you have 790,000. But this is just owing to the approximations of. And so you can clearly see maybe when I was doing it, I missed a one or something. It's possible, especially this side that I was purporting to have something around 43. 45, because I saw that from here to here is 3, from here to here is 3. But because of the rounding, it didn't end up like that. Yeah. So which one is this? Yeah. It's because of the rounding, it didn't end up like that. So you can check yours and you will see that it is probably. All right. So basically that is that. So ladies and gentlemen, that is. So now let's go to talk about the impact of taxation. Impact of taxation. So we are doing investment appraisal now, and we want to talk about taxation. All right. Taxation. Now, one is that tax is paid, and therefore tax is an outflow. So tax will be an outflow. That is one thing you need to understand. So tax is a cash flow, and it is actually an outflow. But if you have a tax credit, in this case, the GRA is owing you, that one will be what? An inflow. So take note of that. Tax to be paid is an outflow, but if you have the GRA is supposed to refund some money to you, then it means that it is an inflow. Number two, tax is paid in arrears. Take note of that, because if you prepare financial statements, this is your year zero, because you've not done anything, you won't be paying tax in this year. This is your year one, your year two, your accounting years. We call these ones the accounting years. Now, watch this. So, if you have to be careful, because the profit that you get in year one, the tax on it, you don't pay it in year one. 2024 tax, people have not even paid the annual tax. They will be paying it in 2025 April. That's the deadline. So tax is always in arrears. So it means that the tax of year one, the tax payable for year one, will be paid in year two. The tax payable for this one too, like this. So this is how it will be. So take note of that. That is how it will be. That is what we mean by tax is in arrears. But be careful, because a question can tell you that tax is paid in the year profit is earned. If the question say that, then you are tied, your hands are tied. So check what the examiner says. So if he doesn't say anything, the default is the arrears. But if he says that tax is paid in the year, then it means that the tax will be paid in that same year. Take note of that. All right, so that is that. So there is that kind of a delay system in tax. Number three is that because you use your money to buy the capex, the depreciation is not a cash flow. Depreciation is not a cash flow. So we don't include depreciation. However, the taxman will give you capital allowance. So you have to be computing capital allowance. So you have to compute the capital allowance. Now, the capital allowance concept too is the same as the tax. Now watch this. We have this years 0, 1, 2, 3, 4, 5, 6. If you bought the asset, and that is the most dangerous thing we are coming to, it's very, very important. It's very, very dangerous because, of course, I've already spoken about the things that you see here. So tax is a cash flow. And one thing you must understand too is that tax is deducted from profit. Take note of that. All right. Tax is deducted from profit. So take note of that. So immediately you get your profit. So revenue minus your cost of sales and your operating expense. Immediately you have to tax it. Take note of that. I think that one is a common knowledge. All right. And it also brings in capital allowance. And the capital allowance thing is something I want you to really understand because it's very, very tricky. It's very, very tricky. So let's talk about the capital allowance. Now, I want you to watch here. So we've been talking about when the asset is bought so that we can claim our capital allowance. We have to be careful about that. All right. But first of all, understand that capital allowance, there are two methods of calculating capital allowance, just like the depreciation. So we have the straight line method and we have the reducing balance. All right. Usually, if a question is silenced, you have to go with the reducing balance because if an asset is bought anew, the strength you have to take more of depreciation because you use it more than when the asset is coming to the end of its useful life. All right. So that is that. But how do we calculate capital allowance? So this is the template. So you will need the original cost. All right. So you need the cost. It's just like the way we do depreciation. So you need the cost. Then you less accumulated capital allowance. Then you get what we call the depreciable base. All right. So this is your new figure and you will calculate your capital allowance on it. All right. Your current year capital allowance on it. Just as the way we do depreciation. All right. Then you get this figure. All right. So that is what you have to know. Take note of that because I will explain this. If the asset is disposed and things, I will explain how that one works when we are looking into it into a question. But stay with me here. Let me explain something to you about this table, this graph that I've done. Now watch this. Capital allowance is claimed. You claim capital allowance in the year you use the asset to produce income. So in the year of ownership, if you don't own an asset, you can't claim capital allowance. Meaning that in the year that you dispose the asset, you will not get a capital allowance. What you can get is what we call balancing charge or balancing allowance. So listen carefully. In the year, so capital allowance is claimed in each year of ownership. So once you own the asset, you can claim the capital allowance. But if you don't own the asset, you cannot claim capital allowance. And it is common sense because the asset is not yours. So you sold it. So how can you go and collect capital allowance for something that is not yours? You get it. So that is that. So that is the most important thing. So each year you own the asset, you can claim the capital allowance. But the cash flow, what we mean, being granted the capital allowance, you can claim. Claim is claim. But you being granted the capital allowance is different because the capital allowance comes when you are also filing your tax. So you see that capital allowance moves with the tax. So your capital allowance for year one will also be claimed in year two, received in year two, this one, it also moves like this. So that is how the capital allowance to what moves. So if you claim it in a particular period, you will get it in the next period. Understood? If I own the asset in year one, I can claim the capital allowance in that same year one, but I will be getting it what in my year two, because the tax filing is also done into the year two. So take note of that. Now, let's come to the major thing. So let me change the ink. So we said that capital allowance is claimed in the year of ownership. That means that if I buy the asset here, I must claim the capital allowance. And so therefore, when will it be given to me? In my year one. If I also bought the asset, the capex that we are doing at this period, when will the capital allowance be claimed? That same period, year one. But when will the cash flow happen? Year two. Don't miss claiming with the receiving of the cash flow. It's two different. All right. You saw the example we did when the workings or the question that I just saw, the timing of the purchase or the timing of the expenditure is very, very important. If a question says that the asset was acquired the first day of the accounting year, good, first day of the accounting year, which one will it be? Which ones are called accounting years first? You know, these are the ones, right? So if the asset is purchased first day of the accounting year or at the beginning of the accounting year, then it means we bought the asset here this year, and therefore we will claim the capital allowance here, but the cash flow will happen where? Here. Have you seen that? But if the question says that the asset was bought at the end of the previous year, the moment you see at the end, because the capex is between this period, these two timings. So if the question said the asset was bought at the beginning of the accounting year, we have this place. And so we will claim the capital allowance here, but the cash flow of the capital allowance will be here. If it is bought at the end of the year, which means at the end of the previous year, because we are not talking about here, the end of year one. We are talking about in between 31st and 1st. That is where the capex happen. All right. So if it is bought at the end of the previous year, then this becomes my previous year, which means the asset was bought here. And because I have the ownership here, I will claim the capital allowance in year zero, but it will be granted to me what? In year one. So this is what we say. The capex can happen at T0, T1, or T1, T1. What do we mean by that? It means that the capital allowance when you buy the asset here, the capital allowance is claimed here. All right, the asset was purchased here, but the capital allowance will be somewhere here. All right, so that is that. But so this one, when we say T1 at T1, what we actually mean is that the asset was bought at the beginning of the year, and so we will start claiming the capital allowance in the beginning of the year. It's just that the cash flow will happen at T2. So this is it. So it's either the asset is bought at TC. So let me write it in this form so that probably I can explain it better. So let's say T0 at T0 and T0 at T1. Let me put it that way. T0 at T0 and T0 at T1. So meaning that even though the asset is bought at year zero, the actual place of the asset being placed is at T0 for this one. And even though it is bought at year zero, the actual place of it happening is T1. All right. So that means that this is at the beginning of the accounting year. This is at the end of the previous year. This is what I'm trying to explain to you. So ladies and gentlemen, If you get this one, you are done, and that is the end. So let's pick up a question and deal with it. So take note of when the asset is acquired. Please take note. And so in my book, I've explained this thing massively in my book. All right. So I formerly in my old book, I used a diagram, but I realized that the diagram is not really important. All right. So I put in a further explanation. So all these things that I've explained is there. All right. So that is that. So listen to this one. This is the most important thing. So you see, if an asset is bought at T0, which is, let's say, 2021, say this is the start of the accounting period. The first ownership is this period. So that is what I've explained. I think I don't need to use. And if that is the case, it will be claimed at T1, but the flow will be here. All right. But sometimes but at the end of the accounting period, now that is the term they use. At the end of the accounting period, please, that one is there should be previous accounting period, but that is how they quote it. So just know what when the word end is used, be careful about it. But please, unless otherwise stated in the exam, you should assume that the asset was bought on the first day of the accounting period. The capers we put at year zero. We are saying that even though we put it at year zero, you should assume that it was at the beginning of the accounting period. So this is the issues there you should be very, very careful about. All right. So I have this example. I'm not going to go through through it, but I want to pick a major question and solve for you to understand. Or better still, if we have time, I think there is time. Let's do it like that. Okay. So take a look at this example. Take a look at this example. When was the asset acquired? He bought the asset at what? Beginning of the accounting year. You have it clear. But there will be another one. End of previous accounting year. So have you seen that? So whenever you are reading the question, take note of that. If the question is not clear, we are saying assume that it was bought at the first day of the accounting year. So therefore, you will always be assuming it like this. So now let's see how we work the thing. If you get a question where there is capital allowance, the first thing you must do is to do your workings for capital allowance. That's the first. So it says that AAPLC buys an asset at the beginning for a 2-year project. The net trading revenue is your operating profit before interest and tax. That is what we call net trading revenue. All right. When you will deduct your tax and do all those things, your capex and everything, we call it net cash flow. All right. So the company sells the asset at the last day. Remember, in the year you sell the asset, you will not get a capital allowance. What you can get is a balancing allowance or what? A balancing charge. So let's set up our capital allowance workings. All right. So in this case, we say that when was the asset bought? The asset was bought at beginning of the accounting year. So this is how it will be. You set up the cash flow. You set up what we call the tax savings, which is the capital allowance. Then you put here timing. Of course, when I did the graph, I showed you the timings. You see these arrows that I drew. All right. So that is that. So now the asset was bought at T0, T1. Remember, T0, T1. Sometimes it's confusing, but manage. And the asset cost is this. And so when we are calculating our capital allowance, the capital allowance will be at T1. That is that. That is where the capital allowance, because this T0 is actually assumed that it is the beginning of T1. So per the question, that's what the explanation I gave you. So what is the capital allowance rate? 25%, and the corporate taxes was 33. So 25.25 by 10,000, I have 2,500. All right, so let me remove these things. So it's 10,000, and the capital allowance is 2,500. So that is that. That's the capital allowance. And so we are going to calculate the tax savings on that capital allowance. and the tax rate is 33. So we will do that. So the balance I get here is 7,500. All right. Then I come to T2, year 2. Now, in year 2, it says that the company sells the asset at the last day of the second year. So if the asset was sold, it is sold. We can't get capital allowance for that. We cannot compute capital allowance here. It is sold. We don't have it. It was sold for how much? So at the end of the day, the asset value is now what? 6,000. That is what? Post-tax. Please be careful because it's very, very important. If it is not post-tax, always make it post-tax. We said that in when we're doing residual value. Remember, it always must be post-tax. If it is not post-tax, you should make it post-tax. All right, so that is the proceeds that the person got. That means that the person made a loss of 1,005 for selling the thing. And if you make a loss, we give you an additional capital allowance on it. Those of you, we've done this thing in principles of taxation. So if you have done that, it's easier to understand that when you sell something and you get a loss, you get a balancing allowance. So that is what we call it, a balancing allowance. All right, because we can't get capital allowance in that year. All right. So here, if you do your 30.33 on 2,500, the tax that you are saving is 825. Which period will you get it? Remember, it will be in T2. Then here too, we are 0.33 multiplying 1,005. That is 495. That will be given what in T3. All right. So somebody says, okay, what if here is a profit? If it is a profit, then we will charge you tax because you have sold something and made profit. So it won't be a saving, it will be a cost. We put it in bracket like that. Is that okay? All right, so that is that. So now that we have calculated our capital allowance, we can set up our investment appraisal table, which is our year 0, and this one is just 2 years. But because of the tax going into year 3, we have to add another year to it. All right, always it makes it like that. So we were told that the net trading revenue, profit before interest and tax, how much was that? This one, there's no inflation, eh? So this is just 5,000, 5,000. That is it. But immediately you get profit, you must tax. So tax, and the tax rate is 33%. So this guy will pay tax. So 0.33 of the 5,000, that is 1,650. It is a tax. Tax is paid in arrears unless the question says otherwise. So this one too, I guess it's the same. 1,650 was the same amount. This is it. Then you come with your capex. How much was our capex? 10,000, which is also an outflow. We have working capital, no, but we have residual value, don't we? Which is an inflow. On which year? The second year, which is how much? It is post-tax, which is 6,000. All right. Then we have the, what do we call it? The capital allowance. Tax savings on capital allowance. So that's how we call it. Tax savings on capital allowance. What were the figures? We have year 2, 825, and year 3, 495. 825, 495. So you now get your figures: 10,000, 5,000. So this one is what? 5,000 minus 1,650 plus 6,000. Because if this one was not post-tax, remember, you see, we tax didn't affect it. If it is not post-tax, you must make it post-tax. It is an after-tax. You brought it after tax. So that is that. Then plus 825. That is one. I have, is it 10,000? 7,500, something like this. All right. Then this one will be minus 1,650 plus 4,495. So that is 11 1155. Then discount factor will be given in the question. Were we given discount factor? Oh, okay, we were meant to just do the cash flows, the net cash flow. So this is the net cash flow. But if you have a percentage with it, you can actually go through it and do. So this is what we've done. All right. So that is that. Take note of that very well. All right. So basically that is that. So let's come to a situation when the thing was bought in. And so if the question is silent, you maintain this capital allowance computation. But even with this, some tutors will teach you that you can do your net trading revenue. I think net trading revenue is 5,000, 5,000. Then the capital allowance, you have to deduct. All right. So if you have capital allowance, you are deducting. It's like depreciation. So I think they go like 2,500 and 1,500. And as far as this one is concerned, it is T2, it is in T1. So they go like 2,500 and 1,500. All right. So that is the capital allowance. And so like the depreciation. All right. So that is that. So it means that let's deduct the depreciation before we tax. In that case, this one is 2,500 and this one will be 3,500. So they are deducting the allowable amount before they tax it. So you tax now 33%. So it will be 0.33 multiplied 2,500. And that gives you 825 as your tax. Of course, tax we've said it's in arrears. So let's push it to the proper place. 825. And the same thing on 3,500 is 1155. So this is our tax. All right. That is that. Now, when they do this, the purpose was for you to be able to get the tax. That's the purpose. So if you have done it, then they come and add it back. So you add back because you want the sole purpose was to use it to determine your tax. And so they come and add it back. So you add back the capital allowance that you deducted. So here too is 1,005. So that is that. You add back. Then they bring the capex now, which is 10,000. Then residual, which was 6,000. All right. What else is left? What else is left? Is that all? I think that's it. Okay. So this is where, so that is what they end up with. Okay, of course, this my own here should have been a negative because it was negative. But you see clearly that it gives you the same answers. Here will be 10,000 and the figures the same thing. So depending on the approach that you can deduct the capital allowance and come and add it back. But I don't do that. I will do my workings because what they've not done is that when they do this side, they don't do these timings to it. All right. So people do that. So the choice is yours. I learned both when I was doing my CA, all right, from my ACCA tutors. So you can also learn both. It gives you the same figures. All right. So now let's look at a situation where it is the end of the previous period. So this is how that one will be. Our capital allowance computation. Look at it. It was bought. So here we will say T0, the cash flow of 10,000. Let me make it T0, 10,000. Tax savings, timing. So here my capital allowance will be also T0. So 25% is 2,500. This is how it will be. Then I get 7,500. All right. So that is that. Then I come to T1 now. So that is how it will be. So I have 0.25 5 multiplying 7,500. So that gives me 1875. That is the capital allowance. Then I have 7,500. I have 5625. Year 2, the asset was disposed at the end of year 2. So in T2, the asset was disposed, all right, but it means we weren't given any value. So that means that the value is 0. Take note of that. That is the proceeds. 0 proceeds. If we're given, so that is a 0 scrap. So here too will be what? 5625 as my balancing allowance. All right. So you go ahead. I think when we did this, we had 825. Timing T1. Then this one, 0.33 multiplied by 1875. That gives me 618.75. Timing T2. Have you seen that? And this one too is 0.33 multiplied by 5625. That is giving me something like 1856.25. Good. Timing T3. So that is that. So if you set up your table, it will also gear to T3. So this is what we have done. So you could see clearly, you set up these figures. Of course, you tax it immediately. You bring in your KPS, then you bring in these things. As you can see, this figure has been rounded, all right? So that's why you see that 169, and this one too has been rounded. That's why you see, then you get your cash flow. Easy peasy. There you go. So we've done inflation and capital allowance, inflation, working capital, deal with scrap value, which will be post-tax, asset replacement. You have to be careful when it is happening, whether it's at the end of the year or at the beginning. Then we've done the impact of taxation and capital allowance. So these are things you have to know. So again, you have this question to deal with. It's good you go and deal with it. So an asset was bought at 10,000, will be used for 4 years, and after which it will be disposed. Tax is 30%, 1 year in arrears. You don't need to be told. That's the general assumption. Capital allowance is this. So you see that in this question, you were not told the timing of the purchase of the asset. I told you that if the timing is not given, then it means it's what? At the beginning of the accounting year. I told you that. All right. So this, if you have my FM book, the assumption is clearly stated. All right. So that is that. So that's why you could see in this question, we started T0, we did it at here, then the timing started shifting. All right. So that is that. Please make sure that you always put the proceeds here to be able to, because some tutors will put the 0 here and come and write the negative, the 5625 here, and get and now tax it. But please, I give you the best. Let the proceeds come. That is the value at the end of the year. Let the proceeds come. Then use this one, because sometimes it is a profit, so that you can actually, if it is a profit, this side will be an additional tax you have to pay. All right, so that is that. Okay, so you go through it and you do. Okay, so now B, it was A and B, so this is that. The asset. How will your answer be? How will your answer change if the asset was sold? That is the B part for 5,000. So now the answer, it's a practice, and that is why I encourage you to get this book. All right, so look at it, you go through it. Question 7, the same thing. All right, the same methodology, go through it. Now, this is where I want to end with. If you get a question where everything is inside, how are you going to go about it? So set up your years, your year 0, 1, 2, 3, and please add an extra year if tax is what? Delayed, where you have cases where taxes arrears, which of course is always so, unless the question tells you that tax is paid in the same year. So find your net trading revenue. We've come to understand that net trading revenue is what? Profit before interest and tax. Interest and tax. And so tax has not already been deducted. All right. So be careful. What do you do? How do you find this one? You've done P&L before. At this level, everybody knows revenue less cost of sales and operating expenses. And that is what will give you this figure. Is that okay? All right. So when you are doing that, inflows must always be before depreciation and tax. We've said that, all right? Of course, it must always be before depreciation and tax. And when you are doing a check for inflation, check whether the thing is real or what, nominal. And checks for cases where we call it increases productions and tax savings. So for some of the questions, the net trading revenue is given already. And some of the questions, they will tell you that the figures that they are giving you, tax has already been subtracted. So check for all those things, all right? Immediately you get your net trading revenue, which we call profit before interest and tax. Please tax it and check the timing of tax payment. The question can always tell you that they pay it at the same year. Also check for tax credits and tax exhaustions. Be careful. This is the situation. Now watch this. If I have my year 0, 1, 2, 3, and let's say 4, all right, and I have profits, inflow here is 10,000, but here is, let's say, a loss of 7,000. Then I come back and make 10,000. And let's say another 10,000. All right, so let me even make this one a loss of 10,000. My question to you is that, have you seen anybody who pays tax when he makes loss before, income tax when he makes loss before? So for example, let's say this side is 25%. So here will be 2,500 tax. All right. And let's say tax is in arrears. So let me just shift this one to this place. It's in arrears. Now, this year, there wouldn't be any tax. Have you seen that? There wouldn't be any tax. So tax will be 0. So now, if you come here to do the tax for this particular one, you must subtract the tax relief anybody has, all right, before you can tax. So we call it tax exhaustions. And a typical way to even better explain it is that because here there wouldn't be tax, the person has lost because something carry over losses. Now that he has made a profit, you have to subtract the previous loss from this figure. If there is any balance, you tax. In this case, when you subtract the previous loss from this figure, there wouldn't be anything to tax again. That's what we call tax exhaustions. If I made a loss this year and the tax is supposed to be paid next year, next year's profit is also there, which will be paid, the tax will be paid the following year. But because I had a loss before, you must offset my loss to the next profit. If there is any balance, you tax. So assuming this side was, let's say, 20,000, I will offset first, get a remaining 10,000, then this one will be 2,500. Clear? That's that, because nobody pays tax when there is a loss. All right, so basically that is that. And so be aware of those things, okay? So if a person has a tax credit, you cannot tax him the following year. You also have to deduct the tax credit before, if there is any balance, you tax. Be careful of that one too. And so when you do that, then you come with your capex. So have you seen how I did it? Get your net trading revenue, all right? Tax it, then bring your capex. When you bring capex, then you bring in residual value. Check it, all right? It should be what? Post-tax, all right? That is that. Then you bring your capital allowance, the one that you calculated it, all right? So take note of that, all right? So take note of that one too. So match it with the tax payment. Bring in your working capital. We've learned how to calculate working capital. If there is any other relevant cash flow, such as opportunity cost, you treat it as per the question says it. If they also receive some grant, which is an inflow, you also put it the year they had the grant. If there is any commission they also pay, you also put it in their respective year. And please, the net cash flow, check if they are supposed to grow in perpetuity. Please, if you have not watched my video on delayed and advanced annuities and perpetuities, now is the best time. Apply your discount factor. Then, please, the discount factor should always be post-tax. So whether real or nominal, when you get it, do 1 minus T with it. It should be post-tax. be careful. All right, it should be post-tax. So after you've converted it from real to nominal, post-tax it again. All right, then you get your NPV. Alternatively, like I showed you, some people, when they get the net trading revenue, before they tax, they will deduct the depreciation. Then they tax, then they'll come and add back the depreciation. Then they continue as usual. If you do that, in that case, you see the steps is 12. But if you do the one that I prefer, your steps is 10. All right. So I give you the two options. So you have an exam question. Now is the time to start doing the exam question. Please remember, we use relevant cash flow. So if something like this cost is not being increased or it is not incremental, ignore it. All right. Remember, we use relevant cash flows. And so don't just be picking figures and be slotting and be doing all the things that you do. All right. So remember that. And that is how I began today's class with. All right. So, and the solution is there. All right. Sometimes the working capital, I told you in the working capital class, it's current asset minus current liability. So sometimes that is how you get it. And there will be no movement according to the question. But at the end of the day, you have to recoup it. So that is that. So this is it. And I've solved it, putting the reason why it is there. We've already done working capital before coming to do investment appraiser in our class. All right. So you should be able to understand that. So go through. I've solved the past questions. All right. Everything is there. Question 7 is an ACCA question. All right. And I give you the answer to as we are taught. So it's a good time for you to pick it up and practice. Thank you. The next time we meet, we are doing capital rationing. And from there, we do specific investment decisions.